My name is Dr. Maya Byfield. My business is The Phenomenal STEMist. I'm so excited to be here in Orange County because it's where I live. I live in Apopka, Florida. And I decided to make this business because I saw a need for underrepresented students to be successful in STEM, which stands for science, technology, engineering, math. And the best way I can do that is just provide products for parents to prepare them, whether it's a book or online STEM camps or just video podcasting. My goal is to transform this community, especially those who are underrepresented. And the way to do that is to help parents understand their children's minds and basically develop them at different stages of their lives to be prepared for a successful STEM career. Thank you so much. That's why I'm here.
Hey y'all. Oh, I forgot to turn the music off. My bad. My bad. Forgot to turn the music off. Hey, hey, what's going on here? It's the phenomenal STEMist. Oh my goodness. The 3-day debt free channel is complete. And I just look back on these last 3 days, starting on Friday, focusing on budgeting and putting organization to my finances. And then I looked onto Sabbath. Yesterday we focused on debt reduction, and today we're going to be getting into just the basics of investing. And as I look through the challenges that I put in phenomenal financial freedom, I am amazed. Everything I put in there is something that has organized me and that I really wished in my 20s that I had for myself. Guys, I'm telling you, there is a whole wealth of knowledge and steps in phenomenal financial freedom. It's kind of discombobulated now because different people are commenting, and as soon as somebody comments on something, it gets pulled to the top. So it's not in any kind of order. So you're just going to have to be diligent in looking through the spaces. Day one is about debt elimination. So every step that is according to day one, maybe I should have just put day one, step one. I didn't think about how it was organized in Facebook, but it doesn't matter if you do it in order or not in order. There is a wealth of information that, man, I really wish I could have had when I was 20. I listen, I'm telling you, the detailed steps in budgeting, the detailed steps in debt reduction, and what I'm going to go through today. Anybody who is in their youth, and I'm talking about 25, 35 to 35, that's what I consider youth in the context of finances, because you really don't have as a lot of money before that. You don't have a job a lot of the times. But truthfully, I had a job in high school. I was getting money in high school. If I had just put a little bit of money away in an Apple stock, let's say, you know, man. So, guys, there's a wealth of information, and what I have is I have a camp associated with it, which is extremely organized. Phenomenal STEM adults. And I told you guys it's free of charge. It's free of charge. Everything that I put in the chat of Phenomenal Financial Freedom, those of you who are not in Phenomenal Financial Freedom, You go ahead and register for Phenomenal STEM Adult, but you're going to have to also register for a Phenomenal STEM Child. Like you're going to have to do a pre-K to fourth grade. You're going to have to do a fifth to eighth grade, or you're going to have to do a high school student. So it's free for you, but you gotta buy a camp for either your kid or someone else's kid. And I'm telling you, it shouldn't be free, but since I'm not a financial person, I don't charge people for things that I'm not skilled at. But what I can tell you though is what I put in phenomenal financial freedom will make you a millionaire. It, it's making me a millionaire, right? Like net worth, I may be almost there. But just I plan to have millions of dollars outside of just my my home and plus all these other things. But when I tell you I was negative $4,000 in debt, and the things that I showed in phenomenal financial freedom, um, the things that I showed on these past two videos and the video today, it transitioned me. So um, it's about follow through now. It's about follow through. Nobody can tell me, no, none of my friends on Facebook or who are in phenomenal financial freedom will be able to say they didn't know. No way. No way. Just these 3 days will make you a millionaire. It don't take much to be a millionaire in America. People don't believe that, but I'm telling you, if you have, okay, how to use STEM for investing. How to use STEM for investing. I hope you guys can hear me. Hi, Anthony. How are you? Good to see you. I've never met you. Who's Anthony Lee? I'm. That's not sticking to me for whatever reason, but I'm glad you're joining. How do you stem for investing and retirement? Um, step one. Step one. Understand your investment options. Understand your investment. Like, what are the different types of investments? So I see, if you can see on the screen, you'll see that there are four main types of investments. There's mutual funds, there's exchange traded funds, there's stocks, there's bonds. Okay. So what's the difference between all of these four? You have to understand all of them. A mutual fund and an exchange traded funds are basically an investment vehicle with lots of diversified stocks and other types of bonds, commodities, whatever. There's different types of mutual funds, and based on the different types of mutual funds, you can have a diversification of many of these different types of vehicles or tools. Not tools, excuse me, investments, right? So you can have a broad mutual fund where it has just all kinds of stocks, small, large, risky, non-risky, healthcare, banks, all kinds of different stocks. Um, Same thing with exchange traded funds, ETFs. So what's the difference between them? The value in them is that you can have multiple stocks for diversification. So instead of just having one stock, and I'm talking about what a stock is later, you have many. And so if one stock goes really bad, you don't lose all your money, because while one stock is going really bad, another stock is going really good, and it kind of balances out. That's what they're saying. The difference between a mutual fund and an exchange traded fund, this is what I know. I'm not a financial professional, but this is based on what I've experienced. Is just how it's traded in the stock market. Like if I want to trade an exchange traded fund, I can do that right away. It works like a stock. Maybe I should have talked about stocks and bonds first, but uh, if I want to buy a ETF at 9 tomorrow morning, when I buy it at 9 tomorrow morning, as soon as the stock market opens at 9:30, it will sell. It will sell. It will buy, it will sell to me. I'll get it. So I can buy and sell right away. That's where it says, if you look on the blue part, it says um actively bought throughout the day. It can go up and down quickly. Mutual funds, you buy it, but you don't really get it till the end of that day, and you don't see the results of what happens till the next day. So if there's like a big swing in the stock market, you can miss that swing because you had to buy it at the end of the day. Like you could have had, a group of, when the stock market was real low in the morning, you could have bought in the morning and been happy, but you had to wait till the evening. And so it was real low in the morning and I could have bought, and then by the time 5 o'clock comes, it's gone back high. So I didn't really get the benefit of a mutual fund. So they're both funds of several accounts. The difference is how you can buy it, how actively you can manage it, or actively you can buy it. Excuse me. It's managed actively, lots of financial advisors, so it's probably a little lot more fees associated with mutual funds than there are exchange traded funds. So I'm very active in the stock market. I have ETFs. I have an so for instance, I have an ETF specifically for artificial intelligence. So yes, I have an individual stock in Nvidia for artificial intelligence, but I don't really put a lot of money. I'm kind of I didn't I have a few stocks in Nvidia, but that's it, right? I didn't but I'm able to buy a lot more of an exchange traded fund that contains Nvidia, but also Microsoft and also Amazon. These are all different stocks that are associated with artificial intelligence. So my ETF in artificial intelligence only went up 10%, while Nvidia went up 46%. Right? So I made more money with Nvidia than I did with the exchange traded fund, but I made money in both situations. Just I made less money with the diversified because while Nvidia is going up, Microsoft was coming down a little bit, and it kind of balanced out to only give me a 10% gain. But a 10% gain ain't bad. 42% gain is amazing. And I told y'all in Phenomenal Financial Freedom, I was buying it. I don't tell people what to do. To Anthony's point, to Anthony's point, how can I invest with if I have been red flagged by many banks because I've been scammed so many times? You've been red. I don't understand what it means by being red flagged by banks. Um, I'm not a. I'm not a. Um, I'm not a day trader. I don't really get into the day trading field. Um, yeah, so I wouldn't know that, Um, yeah. So I can't answer financial questions in that regard, Anthony. All I can do is tell you what these things are based on my education and experience. All right, so stocks are, you know, ownership of a part of a company. So a company is trying to raise finances. Example, Microsoft is trying to raise finances so that it can do all kinds of new things. And they don't want to wait till they get profit to then invest their own profit in their new thing. So what do they do? They sell a piece of their company to others. So they rate. So I think Microsoft right now is at $400. So if I buy 10 shares of Microsoft, I have spent $4,000. So I have $4,000 worth of the share of that singular company. And as long as that singular company is going up, my $4,000 will go up. Why? Because the stock will go up. It'll be worth more, and more people will want to buy it, and it'll be worth more to sell it. And they'll give me dividends and capital. I'll get gains from the increase of the stock, and I'll get gains from the dividends that they give me for owning shares, right? But it's a singular piece of a company, so it's extremely volatile. But I don't pay any fees to own it because I am in charge of the management of my stock portfolio. So let's say I have a few stocks. Few stocks. I don't have a lot of stocks. Warren Buffett suggests that before you start investing in individual stocks, you should invest in low cost index funds, which is a type of mutual fund. Um, it's not an exchange traded fund. It's an index fund. It really like matches the broad index, meaning all the top companies that are part of the Dow Jones index or the S&P 500, the top 500 companies. I get a broad basis of those funds, and they have low fees, low cost. Before you start trying to, Anthony, you were talking about investing, did you put $10,000 in a low cost investment fund first? That's what you should do. Like, a novice shouldn't be day trading, in my opinion. Many people say they should. Warren Buffett says, you before you start doing in individual funds, put $10,000 in a raise $10,000 over time. I'm not saying put $10,000. I'm saying every year put $2,000 for the next 5 years, and all you're putting it in is low cost index funds. And then train yourself about stocks. Learn about stocks. What's happening is there's too many, we call them retail investors, people who are just gambling with stocks, have no idea about the stocks they are buying, and they're just putting money, and then when things go bad, they sell fast, they buy high, they sell low. Versus the people who are really educating themselves on the stock market are taking their time. If you want to get rich quick, get out of the stock market. The stock market is made for people who are willing to study. So, stocks are so volatile. In my opinion, you shouldn't be in it until you have $10,000 in a low cost index fund, right? And then once you learn, like, there's some stocks that will never die. I'm not a person that just starts picking stocks and stuff. The stock for me, I get into stocks that I feel that are so foundational to something that they're too big to fail. So the bank stocks are going down, but they always went down, and I always get happy when they go down because I just don't believe the banks in America are going to fail until the Lord and Savior Jesus Christ comes. But then everything fails. So then that's another story. Like, but as long as Earth is here, I believe American banks will be here. When the pandemic was happening, there were only two things open: the hospitals and the banks. The hospitals and banks were open. The schools were closed. The churches were closed. The grocery was open too. Grocery stores were open, but they were managed properly. Banks were open. Hospitals were open. Everything else was closed. You see my point? Technology was open. So of the 5 to 10 stocks that you may create a portfolio in after you invest in your index funds, make sure that they're too big to fail, in my opinion. There could be some risks to it if you want. That's fine too, because you have to determine. Well, we're gonna talk about that a little later. Bonds are government loans to people. They're loans. So you get paid off the interest. So it's a little bit more stable because you're only getting paid off the interest, not necessarily the great rising. Okay. Step two, assess your risk tolerance. Like how, you know, how risky are you? A conservative? Are you moderately conservative? Are you moderate? Are you moderately aggressive? Are you aggressive? Like which one are you? And I put in the chat, I put in the Phenomenal Financial Freedom a test. Did you take the test? Take the test. Take the test. Take the assessment to see how risky you are. Or there's going to be a time if you have, a brokerage account, they're going to ask you how risky you are. And it depends on a lot of things. It depends on your age. Somebody who's young needs to have risk, in my opinion. You should be more aggressive. Those of you who are older and need the money more sooner, you might need to be more conservative. But you might need to be aggressive in other cases. Like I have my mother conservative in her retirement account. She has a pension as well, but I have her aggressive in her individual account, because in her individual account, it's not for her retirement, it's for her elder care. And her elder care is another 20 to 30 years late from now. That's enough time to be risky. You see? So even old people need to have a little bit of risk. Not a lot of risk, right? So your retirement, your pension is conservative, but then you have to put away a little bit of money that is risky. So but that's more for long term, 20 to 30 years out. Because the stock market will crash and recover within 20 to 30 years. We've seen it in history. We have historical data to be confident in that. So determine your risk level through assessment. So use different types of tools, online tools, to determine your risk level. Step number 3, set up the account, guys. Stop talking. Set up the account. Set it up. So Anthony was like, I want to start investing with $20. Where are you? I want to start investing with $20. I suggest? I suggest you set up your account and you create a plan. There are different types of accounts. They're all on here. I'm a fan of Charles Schwab. They talk to Chuck, right? Create a plan. There are different types of plans. So I talked about that in Phenomenal Financial Freedom. I don't know, Anthony Lee, I don't know if you're in Phenomenal Financial Freedom Facebook group, but please join. And I have different things. I am a person that believes in first doing your tax free vehicles like the Roth IRA. The Roth IRA, the 401k up to the company match, which is usually about $3,500, right? Those of you who have businesses, the solo 401k, which is $22,000. Like you need to max out those that grow tax free before you're getting into individual accounts. These IRA and retirement accounts are forcing you to keep the money long term. See, the problem is too many people try to buy and sell and take the money for themselves. That the stock market is meant to grow for long term, like all the way to when you're 60 years old. And the benefit of these kind of vehicles is that it protects your money from being taken from people. You cannot easily give away your money. There's too many, to your point, Anthony, there are too many scammers out there. Friends and family, forget just strangers asking for money. If you put your money away in these kind of vehicles, IRAs, 401ks, then you can tell them I'm not allowed to take it out. If I take it out, I'm going to be penalized. Then they can't make you feel bad. They say, "Oh, let me borrow $1,000." No, I don't have $1,000. I got $200 in my savings account. Why? Because you put all of your money in IRAs, 401ks, which will not allow you to take it out until you're 60. That's what you need to do. And you need to put your money in these low index funds. $20, I don't care what you put in. $20, $10 every week, every month. Set up the plan. First, a Roth IRA. If you have a 401k, 403b, right? Everything that, and then you can get into your investing accounts. And for those of you who don't really understand what to do and all you want to do is put your money away, get a robo advisor account. Things like Betterment and Wealth. I put all that stuff in Phenomenal Financial Freedom. Then they'll have artificial intelligence and robots doing it for you. And when you try to sell it, they'll be like, you can't sell it. It's not time to, like, they will not let you they will take charge of your money. And some of you, that's what you need to do, because you'll let your emotions drive you. You let your emotions drive you rather than your 50-year-old, 60-year-old self 30 years from now. And your 50 and 60-year-old self 30 years from now are going to look back at your 20 and 25-year-old and 30-year-old self and say, "Why did you give away that money? Why did you spend all that money?" They'll be so frustrated with you. But you won't know that because you're not there. That's why artificial intelligence, that's why these vehicles stop you from making foolish decisions. Step number 4, create a trust. Create a trust. You got to be able to protect these investments. Protect these investments. What is a trust? A trust is a legal document that outlines all of your assets and protects them from outsiders. That's the simplest way I could say it. It has your information. It has all your beneficiaries' information. It has the person that's going to manage the trust, which could be you or somebody you trust. And literally, you list all your assets and you decide who gets what. And that's it. That's it. It's protected from the courts, it's protected from the government. It's for your beneficiaries. After you take all this time investing and building your income, you need to protect it with a trust. Guys, I hope this has been helpful. Just the basics. Just the basics. Once again, I have all of this information in a more organized way in Phenomenal STEM Adult, which is dealing with finances. Phenomenal STEM Adult. It's free of charge. This Phenomenal STEM Camp Adult for finances is free of charge. However, you have to connect it with a virtual STEM camp for your children or somebody else's children. Register on www.phenomenalstemist.com and you'll say, I want Phenomenal STEMist Adult and I want beginner or intermediate or advanced. That's either for a really young child, pre-K to fourth grade, or an intermediate, fourth to eighth grade elementary child, or a high school student. Help your child in math this summer and help yourself in finances. I hope this has been helpful for you. I'm so appreciative of your time and your attention and your participation either through Phenomenal Financial Freedom app or basically commenting on tonight. Guys, it's been great. I'm telling you, the information is priceless. I hope you take advantage of it, and I hope you follow through on it. You guys have a great evening, and I wish you all the best financially. I am the phenomenal STEMist. Good night.